Okay, we might just get started. So good afternoon, everybody, and you're very welcome to this afternoon's webinar on the Revenue Debt Warehousing Scheme and the reduced rate of interest on other tax debt. I'm delighted this afternoon to welcome Pat O'Shea, who's a Principal Officer with Revenue, who has generously given us his time this afternoon, and he will bring us through some of the detail of both the Debt Warehousing Scheme and the reduced rate of interest. I'm also joined this afternoon by my colleague Kim Doyle. Kim is Tax Director with Grant Thornton, and Kim will moderate the Q&A session. Throughout the duration of the webinar, feel free to post any questions that you may have as we're progressing through the presentation. We will do with the quick Q&A session at the end, and as I said, feel free to post any questions as they arise during the session. So without further ado, we might just move on. So firstly, I suppose where the sorry, the slides are not moving here. Val, if you just want to. So just in terms of the debt warehousing scheme, just to give a very brief overview as to where the scheme originated from. So it had its origins in mid-March. At the time the country went into the lockdown period, Revenue very quickly announced that they would be suspending all debt collection, and they would also be suspending any charges on the interest for late payment of VAT for the January and February and March-April periods, and for payroll for February, March and April periods. This was subsequently then extended to include the periods for May and June. One of the conditions that Revenue had sought was that all taxpayers and businesses wishing to avail of this relief would continue to file their returns on time, so that Revenue had a sense of the amount of unpaid taxes. So early in May, we were made aware that there was going to be some legislation brought in to provide for a debt warehousing scheme that would give more permanency to this arrangement. And the July stimulus package, when it was announced in July, provided the legislation to give Revenue the powers to warehouse what has become known as the COVID-19 tax debt. So in terms of the COVID-19 tax debt, we're looking at the restricted trading period plus 2 months, and Pat will give us quite a bit more detail on that as part of his presentation as to what that means for different businesses. Secondly, the debt that could be warehoused was your COVID-19 period payroll and VAT debt, and this will be warehoused at a rate of 0% for 12 months, and after that the rate of interest will be 3% per annum until such time as that debt was repaid. In terms of businesses that would qualify for the debt warehousing scheme, all SMEs automatically qualify for it, so there was no need to contact Revenue. And simply what Revenue have done is they have tagged the various debts referred to in the COVID-19 tax debt period as warehoused. In non-SME cases, so just to remind us, SMEs are businesses with turnover of less than 3 million. So for businesses that are non-SMEs, it was imperative that they would contact their revenue district, be that large cases or the medium branch contract, to enter the arrangement formally with the Revenue. And I suppose our experience to date has been that in the case of larger businesses, Revenue have been very proactive and very efficient in approving the debt warehousing regimes for clients who meet the criteria. So then a second aspect to the July stimulus package, just move on, was the reduced rate of interest, which applies where you already have a payment arrangement in place with Revenue. And again, Pat will look at this in a little bit more detail later, but effectively what it provided for was a 3% rate per annum on these debts, as against the normal interest rate that applies of 8% or 10% per annum. And this was applicable from the 1st of August 2020. So I might just pass on now to Pat, and he will take us through a deeper dive into both the debt warehousing and the reduced rate of interest. Thank you, Pat.
Okay, Emer, thanks very much. Great to get an opportunity to go through these two measures. So kicking off there with the first slide, and as Emer said, like, there were two measures to ease the burden on businesses' return to trading in the COVID period and post-COVID period as part of July's stimulus package. And I suppose the main point is the legislation effectively came into effect on the 1st of August, even though it was signalled well in advance. And in terms of warehouse, I suppose the real kind of question is what can be warehoused and how do we arrive and understand that? And this to me is kind of the general / golden rule on it. And I suppose the fundamental thing you have to kind of get into your head is what is period one, because period one determines the debt that can be warehoused. So how do you determine it? Well, the main kind of test is the return to trading test and in the context of the government roadmap. And then there's effectively a bonus 2 months on top of that that can be included. And as an absolute minimum, that can actually range almost up to 4 months, depending on when in the cycle you return to trading. Apart from that, the other, I suppose, complication or item you have to take into account is the filing pattern of the business. And we have a fantastic variety of filing patterns. We have the standard filing patterns of monthly prem and bi-monthly VAT, but then we have quarterly prem, and then we have 4 months, 6 months, and annual VAT, and we have an annual prem as well. So all of those, or many of those, kind of have different end dates, and they don't match in sync. So the real test is to understand what decides as what the end date for period one is. And the second part is really to figure out what fits in there if you're not part of the standard filing pattern. And as Emer said, all SMEs automatically qualify, and they're actually designated in the legislation by reference to our business division and personal division. So a business that's in either of those divisions automatically qualify for warehousing, and LCD and MED, they qualify on application if they've suffered. So they need to apply to us and look for the warehousing exemption. And a good number have applied, and hopefully the response, as Emer said, has been quite quick. Generally, in terms of warehousing and the other stimulus measure, there's a very good information booklet on the Revenue website, and the link is there at the bottom of the screen. So if you need to get any more information or check out what I've said, I think go and have a look at that. So this, in a way, this slide is warehouse on a slide, and there are 3 key periods in terms of looking at warehousing. Period one is what I've just started talking about there, and that really is where you identify the liabilities that can be warehoused. And the first important point is that it is confined to VAT and prem. And also, it's really important to find out that we don't go anywhere unless the returns are filed. So as I said, automatic for SMEs and for business and personal division LCD on application. And the end date again is when you return to trading plus the next bi-monthly period. So for example, a business that returned to trading early on, let's say phase one in the May-June period. So they could have returned, I think 17th of May was the kickoff date for a number of businesses. So May, June, and then July, August becomes the end of period one. So all debt up to the end of October, up to the end of August can be warehoused. And then 1st of September for that particular business is the beginning of period two. And period two is where you park the debt. Now, period one, the debt as it built up, 0% interest. But for all of period two, which is a 12-month period, it's 0% interest as well. So that runs for the 12 months. Again, current taxes must be paid and all returns filed. And during that, if a business feels it wants to, there's an opportunity to make payments against the warehouse debt so they have less liabilities when it comes to the end of period two. There is absolutely no obligation. It's entirely up to the business that can be made on an ad hoc basis. We are planning to provide a form of direct debit facility which a business may use if they want to enter a kind of a structured payment against it. Again, there's no obligations, there's no penalties associated with it. It is a form of PPA or phase payment, but it doesn't have any of the conditions associated with it, as there's no obligation to pay off those liabilities during period two. And then that follows on to period three. So for the business we spoke about that had a period one end date of the 31st of August 2020, period two ends on the 31st of August 2021, and period three commences. And period three is all about repaying. So the idea is that you either pay in full at the beginning of period three or enter a phase payment arrangement. And entering a phase payment arrangement means you can avail of a reduced interest rate over the lifetime of the arrangement. So in this particular scenario, none of the VAT or prem that has been warehoused during the COVID period and for the 12 months thereafter, no interest has accrued on that. And then over the lifetime of the repayment period, 3% interest, which is quite favourable terms. And we are a lot more flexible in terms of the duration and any sort of down payment that would be required as well. Okay. So we might move on to the next slide, please. Okay. This is the filing pattern. Now, this is a very simple slide, but we could be here for the rest of the day going through all the scenarios in this. So it's just really on one slide, just trying to show roughly what the rules are around it. So if you look at the standard on both for VAT and Prem, that's generally lovely and clean, because standard VAT is bi-monthly and period 1 is determined by reference to the end of bi-monthly periods. So it's lovely and clean. If you're a standard VAT filer, it's very easy to figure out what debt is covered in the warehouse. Similarly, if you're a standard Prem filer, it's very clean. It will all fit neatly within your warehouse start-end date. For 4 and 6 monthly, it becomes a little bit more complicated on the VAT side. But there's a basic rule. It's basically it, and that is, if part of that accounting period is in, then it's all in. If we just take very briefly the example of our friend who returned to trading in July, August with the end, May, June with the end of August as being the cutoff period for period 1. For the 4 monthly VAT filer, that's nice and clean, because that's 8 months into the year. And the first 2 triannual VATs, 4 monthly VAT returns, fit neatly into that. If that business happens to be a quarterly VAT filer, it's a little bit more confusing, because now the 3rd quarter brings you up to the end of September, but you can bring that 3rd quarter in. So the advantage for simplified filers, by and large, is they get additional debt into the warehouse. But the fundamental point is it does not affect the end date for period 1. And we'll go through that a little bit in the examples in a moment. The annual filers then, a little bit more confusion again, or complication again. The annual VAT or Prem is pretty clean, part in, all in, and it's a January to December period, so it's very clean that way. Annual VAT filers are a bit different. Their end of year can be basically any month in the year. What the legislation provides for, if your year ending is falls within your period 1 and it's between February and the end of period 1 plus the next month, and that's just, I suppose, a little bit of a concession on that front, all that annual VAT is in. Again, these are specific circumstances. If you're not an annual VAT filer, you don't really need to worry about this at all. We might move on to a couple of examples to see if we can kind of solidify some of these particular scenarios. So if we could go on, yes, lovely. So we have Pets Corner returned to trading in June. So once it returned any time in the period of 1st of May to 30th of June, that's the bi-monthly period it returns in, and it has the next bi-monthly period as well to determine the end of period 1, which is the 31st of August. So it can include the next bi-monthly VAT as well. So this is a monthly Prem and a bi-monthly VAT. So it's lovely and clean. So if we look at the Prem, it's all months from February to August can be warehoused. The reason January is not included in the warehousing relates to the general principle around warehousing was debts that arose or fell due to be paid during the COVID period. February or January Prem for a standard filer would have fallen due for payment in February, so it would have been ahead of COVID kicking off in this country. So that's why it's excluded. And it's excluded by the legislation. It's not a decision on our part. The difference with VAT, which is bi-monthly, the January, February VAT was due in March, which was within the COVID period. So you're actually including all 4 returns for VAT in this particular scenario. So that's as clean as it gets really in terms of determining period 1 and the returns that fall within it. And many people fall into that category, but many don't. So we might move on to another one. Lovely. Murph's Pub and Grub. Okay. So Murph returned in July. So July, August then is the bi-monthly period it's returned in. And September, October is the next 2 months you can add on to determine your end of period 1. So if we now look at the Prem and VAT in this situation, sorry, this is a straightforward one as well, so it's lovely and clean. The next 2 are the tasty ones. So again, we can fit in all months from February to October warehoused and all 5 returns. It's just the significance of moving on to another period and the implications it has for the end of period 1. That's the real difference between these 2 examples. So now we might move on to another example, please. Okay, the DIY store. So DIYs opened in phase 1. So if a business opened in phase 1, so it returned in May, June. So period 1, as in the first example there, will be the end of August, 31st of August. That's the end of period 1. So we have now nailed down period 1, and we have nailed down when the business, and that was determined by when the business returned to trading. This customer files quarterly prem. So what that means is the first 3 prem quarters can be included. So that's 9 months, even though period 1 ends in August. So that's the advantage of being a quarterly filer for prem in this. On the other side of the coin, just to point out that period 1 ends on the 31st of August. Period 2 will still end on the 31st of August 2021. So the prem for September essentially has a month less in the warehouse, but you have more debt in the warehouse. So just that's the significance and the confusion that can arise around when the period ends and what you can put into the warehouse. In this situation, the VAT is quite clean. Sorry, just go back. Could you just please? The VAT is quite clean because it's a 4-monthly VAT. So the first 2 4-monthly returns neatly fit in to the end of period 1 to the end of August. So we have 2. They're both non-standard filers. One fits in neatly and one doesn't. So depending on what month you return in, the goalpost can move generally in a different direction as well. So we will have a look at a couple of those maybe later on, or there's a couple of examples worth discussing in the context of, say, wet pubs opening and things like that. So maybe we could move on to the next slide, please. So Tasty Bites, okay, returned to trading in July. So this is the July, so the end of October, September-October period, the next bi-monthly can be included. So if, for example, if Tasty Bites returned in the first week of July, it actually has up to potentially 4 months of trading in the warehouse. So you look at the window in which the business returned, the bi-monthly period in which the business resumed trading. If you're early in that bi-monthly period, you have all of that bi-monthly period plus the next 2 months. If you're late, you have 2 months. So that goes back to the kind of general rule. You have a guaranteed minimum of 2 months, but it can extend to 4. So if we look now again at our prem, in this case, it's an annual filer. And because it's an annual filer, under the legislation, part in, all in, the full year is in. So all that year will be warehoused. Now, this business's return to trading, or sorry, end of period 1 is the 31st of October. The annual filer's return will not be due until 2021, 3 months later. So again, to make the point, the end of period 1 is 31st of October. The end of period 2 is 31st of October 2021. The annual prem, you're getting all your annual prem in there, but actually it won't be in there for quite the full 12 months. So that's just understand that point. In relation then to the this customer is a 6-monthly VAT filer. Again, period 1 ends on the 31st of October, but the VAT second 6-monthly period runs to the end of December. Under the rule in, part in, all in, the full VAT is in. So this customer gets the full prem for 2020 and the full VAT for 2020, notwithstanding the end of period 1 is the 31st of October. Again, it's just the unusual circumstances that apply to non-standard filers and what the legislation provides. Okay, so again, maybe, I'm not sure that may well be the end of the slides on those. Before I go on, I suppose really the important point to make here is get your head around it. You really have to understand how you determine the end of period 1. And the fundamental part is, when is the return to trading in line with the government roadmap? And then what bi-monthly period does that fall within? And you have the next 2 months on top of that. And then the other consideration is, what is your filing pattern? And that's what determines what fits in under the warehousing provisions. You then have your 12 months of interest-free 0% rate, which may or may not be the full 12 months for some of the debt that has gone in, but you're getting extra debt in. And then you need to consider within that period, you need to consider when exactly or how you would intend to approach repaying that debt. And you have the opportunity of making part payments or enter a structured payment format or direct debit, which is not available yet, but will be available. Again, as I say, no penalties associated with it. We will be writing to customers at the end of September, early October, advising them of what we take to be what's in the warehouse and their obligations, essentially. And the critical obligation to be in the warehouse is to make sure you file returns. And some of the points that have arisen, people may not be able to file returns, therefore they won't be in the warehouse. What we have said, our revenue has said on a number of occasions, if you are not in a position to file a return, if you file your best estimate, we will accept that. But it's absolutely critical the returns are in. That is the one kind of absolute must-have in order to stay in, to get into the warehouse. And the second to stay in there is to make sure you continue to file your returns during period 2. So return filing can't overemphasize that enough to get in the door on warehousing. So that's essentially the end of the warehousing. Is it worthwhile to kind of consider some of the questions around that before we move on?
Yeah, I think that makes sense, Pat.
Yep, certainly. Hi everyone. Pat, yeah, that would make sense now. As Emer said as well, to stop, I suppose, and pause, and also to take on board, or to digest some of the comments you've just summarised there. And I suppose you've made it certainly very clear that the key point is, file returns to access the warehouse, but also to continue, to file on time to remain within the warehouse scheme. So I suppose it's important, as you said, that is highlighted again. So we do have a couple of questions in, and one you've mentioned, and it's just to pick up on it in terms of a specific question, is it around that whole area of the wet pub businesses. So these are the pubs, I suppose, that don't serve food. I've just learned that as of today, and are due to open later this month. So the specific question, Pat, I think is probably more for yourself, is what is period 1 under the debt warehousing for such wet pub business?
Okay, so the target date is the 21st of September. So we're in the September-October bi-monthly period. So that means November, December is the next bi-monthly period. So 31st of December essentially is the end of period 1 for a wet pub, as we call it. Okay, and then it boils down to what is the filing pattern for the pub. So if, for example, it's an annual prem filer, well then the year is in, but there's no extra benefit if you want to look at it in that respect, in the sense that it coincides exactly with the end of year. If it's a bi-monthly, it's one of the cleaner ones, to be honest, in that respect, because if it's a bi-monthly, triannual, or biannual VAT, end of year also happens to be the 31st of December. Same with prem, quarterly. It's one of the times where your quarters, which are three monthly, and your VATs, which are 4 monthly, coincide. Actually, I think it's the only time of the year they coincide. The only one that could be a little bit different is an annual VAT filer. So that is the only category of customer who would be a little bit different. So an annual VAT filer who files up to the end of January, because of the rule is if it's between February and the end of period 1 for annual VAT filers. So anybody who has a year ending in February, and the reason again year ending in February is the cutoff, or is the kind of the significant point, is ending in February means the debt is due in March, which was when COVID kicked in. So that's why the warehousing kicks in. And the concession or kind of extra bit that's in the legislation is that 1 month, period 1 plus 1 month. So period 1 in this case is ending on the 31st of December, plus 1 month is January 2021. So that's the only customer essentially who might have debt outside that goes beyond the end of the period. It's one of the, I suppose, neater examples you can have. It's the neatest example you can have with with reduced filing patterns.
Okay, and many thanks, Pat, for that detailed explanation. It seems to be certainly a lively topic at the moment in the area of wet pubs. And just in terms of other questions on the warehousing, I think again, one maybe more for yourself is, can you confirm whether preliminary CT applies to the warehousing?
No, preliminary CT or preliminary anything can't apply to warehousing in a sense. The fundamental around being in the warehouse is the tax has to be due. So if the tax isn't due, then it can't be in the warehouse. Preliminary tax by its very nature isn't due until the following year. So it's a different kind of it's very different altogether. So, and for example, one of the questions that has been surfacing elsewhere is whether or not if you file your IT early, does that get in the door? And the answer is no, because it's not actually due until 31st of October. So the deadline for being, sorry, hold on.
That's maybe the reduced rate of interest.
Oh no, I'm looking at the first screen there, and I have moved on already.
You're fine, Pat. I think the answer to that as well also is though the fact that the debt warehousing is only for Prem and VAT. Isn't that the case, Pat? So CT wouldn't be in the debt warehouse in the first instance anyway.
Yeah,
it wouldn't. No, it wouldn't.
Yeah.
There is a way. Yeah, okay. There's an interesting angle on the CT on the PPA, but no, you're correct.
We'll look at that when we exactly.
Yeah. So I suppose just to we will come on to the reduced rate of interest next, and I suppose just to I suppose maybe it's no harm to say it again. The warehousing, as you said, Emer, it covers the VAT and POI COVID liabilities only. So I suppose any preliminary tax, as you said, Pat, is out completely, but then CT is out, so preliminary CT would be out, and that I was just addressing that question there for that attendee. We have another question earlier on, but I think that we'll hold that for the reduced rate of interest as well. And what phase payment arrangement periods will be considered? Maybe we might hold that as well when you've discussed more on the phase payment arrangement, Pat, at the next set of slides. And then we have another question just coming in as well. I think we'll just hold that until the reduced rate of interest, if that's okay for that individual. Just one, I suppose, just most recently after coming in, an attendee here is asking is, what is end of period 1 for the essential business that didn't actually fully shut down at any stage? Pat, maybe do you want to take that one?
Okay, so again, it depends where that business resides from a revenue perspective. Like, so if it's a MED or an LCD case, that's one category. But if it's a business or personal division case, well then under the legislation, it automatically qualifies for warehousing. It didn't shut down, and there will be other businesses that kind of continued at a reduced rate. And the approach that's being taken is that any business that continued and automatically qualified for warehousing would be deemed to fall within phase 1. So a business will be deemed to have been running within the May-June period, which means the end of period 1 is the 31st of August. So that's either for a business, for any business in those automatically qualifying situations. If the business was trading merrily and was a MED or an LCD case, well then it wouldn't qualify for warehousing.
I suppose another point, Pat, again, just to pick up on that, because again, this point has come in, or this query has come in from clients over the last number of weeks. And I suppose it's something we were just discussing before we came live here in terms of the reduced trading period as well, or where businesses have been trading at a very reduced level anyway. The level of the VAT and the Prem is probably going to be greatly reduced also by virtue of the lack of trading. But you know, I suppose it's very much down to the dates, and as you said, what period you're looking at there.
Exactly. It is, and I know some businesses are saying, look, I haven't returned to the level I was operating at before. That isn't the issue. The issue is, are you trading, I suppose? And the other kind of really question maybe many businesses don't know, unfortunately, is the rate they're trading at now going to be the new normal? So the very point you're making as well, like, I mean, extending the warehouse, if the business is trading at a very low level, is of limited benefit in the sense that there's very little to go into the warehouse. I suppose once the main point is for any business that was really shut down and is getting itself back up off the ground, it does have that buffer of an additional number of months in its initial trading period, where it is trading and could be back doing reasonably well, and hopefully it is, but that can be warehoused. So there is that buffer of a minimum of 2 months, and depending when in that 2 month cycle you return, or the previous 2-month cycle you return to trading, it can potentially be 4. And again, I suppose it will work very well for some people. Others may struggle. I suppose that's the difficulty with any solution. Like you have to just try and be pragmatic around it, and it is what it is, I suppose.
Yeah. I suppose we have just another question to come in there now in the last few seconds, and it's linked again to this discussion around when does period 1 end. So say, for example, you have a quarterly prem and a bi-monthly VAT scenario, and they reopened at the end of June. So say the 29th of June, for example. Sorry, just...
Okay,
then,
so they opened.
They opened at the end of 29th of June, quarterly prem and bi-monthly VAT. When would period 1 end? Would it be the end of August, or would that be correct?
Well, the first thing you do is the actual filing period of itself, the filing pattern of the business doesn't determine the end of the period. So we're back to figuring out when did the business return, the first question. So they returned in the May-June bi-monthly period, the bi-monthly period. That's just the only significance of the bi-monthly period. You're figuring out which bi-monthly VAT period did the business return to work. So it returned in the May-June period, so it's entitled to have the next 2 months as its period 1. So that brings it up to the 31st of August. So now we see what is the position at the 31st of August. So we're at the 31st of August, because I think you said it was a bi-monthly VAT. That means that's nice and clean. It brings in all the first 4 VAT periods. It's a quarterly prem, but that means, and so that is up to the end of September. But because part of the prem is within period 1, by the 2 of the 3 months are in there, the 3rd month can be brought in there. So it brings in the 3rd quarter.
Okay. And just, I suppose, linked to that question as well from the same attendee is, if PAYE is a quarterly return, is January captured in that then under the warehousing, the prem, the January prem? If
they're a quarterly filer?
Yeah, they're quarterly prem.
For that particular case?
Yeah.
No, because the warehouse has period 1 ends on the 31st of August. We're bringing the 3rd quarter in because part of it's in there. None of the 4th quarter is within period 1.
I suppose it's not clear with this, but the way I'm reading it as well on the alternative is January of 2020. January, February, March, April, the first quarter.
The first quarter
the
of
first quarter of
2020.
January.
I beg your pardon. Sorry.
That's the way I read it.
Yes.
Sorry, and it's easier for me, I suppose, because I'm reading it. But I suppose I took it that because it's quarterly prem, would January 2020 be bundled in to the warehouse as well?
Absolutely. Yeah. The only scenario, I think, yes, where January prem isn't in it is where the business is a monthly filer.
Yeah. And that's been our experience as well, Pat. That has been our experience, that quarterly filers, the Jan prem was pulled in as part of the January, February, March prem and into the warehouse.
Like, I mean, we're back to the simple rule. Well, in so much anything is simple on this, is if the due date fell within the COVID period, and by and large, the COVID kicked off here on the 15th of March. Right. So if you think about it, the January, February VAT was due on the 23rd of March. So it was sucked in. The January prem was due on the 23rd of February, which was before COVID kicked in. The quarterly is due in April, so it's in. So it really is debts falling due within the COVID period, or as such. And what it has, well, the legislation says when the business was affected, and it can't be any earlier than the 1st of January for VAT, or earlier than February for prem. That's what the legislation says. But like, I mean, the easiest way to think about it is, I think, is when did it fall due? Did it fall due really after the 15th of March? And then you're in the space, if that was the due date for that particular return or / accounting period, because we get very confused. We have monthly returns for prem, but we have a quarterly accounting period. So the accounting period is due on the 23rd of April. So that's well within COVID period.
Okay. Great. Thanks very much, Pat, for clarifying those number of questions put to us. I think that's all. So certainly I see now on the warehousing side, if anything else comes through, we can pick them up at the end of the reduced interest slides, reduced rate of interest slides. But for now, I suppose we'll just we'll move on then, and we'll hold any other questions to later. That's okay.
Yep, that's perfect. Okay, I kind of nearly rushed into this a little while ago. So we'll move ahead with the reduced interest. So this was also part of the stimulus package, and it introduced a new rate of 3% for phased payment arrangements. Now, there's a really critical point to make at the outset of this, is that this is for interest over the lifetime of the arrangement. So it's really important to point out that accrued interest up to the 1st of August or the date of agreement still applies. So essentially what this is, it's an opportunity to deal with non-warehouse debt. And unlike the warehouse debt, which is confined to VAT and Prem, this applies to all tax heads. So it's a great opportunity if insofar as anybody likes paying tax, but it is a very good way, a great opportunity to deal with arrears of tax with a very favourable repayment rate over the lifetime of the arrangement. So the new interest rate is 3%, 1st of August or the date of agreement. What that means is, if obviously you're not going to be in on the 1st of August at this point in time, but if you come to us before the 30th of September, you're in the door. And this is really a very important point. It is something that has been made available in terms of the legislation with a finite cut-off date. In terms of the 1st of August, the businesses that have come in earlier and we have got quite a number of phased payment arrangements in place already, but ones that would qualify automatically from the 1st of August are phased payment arrangements that were already in existence. So if you had a phased payment arrangement with effect from the 1st of August, the interest applicable to the unpaid tax at that point in time, the rate applicable to that will reduce to 3%. In most cases, it was either 10 or 8 based on Emer's first slide. For the majority of taxes fall into that category. So VAT and Prem would be the 10% rate, ITCT would be the 8% rate, so that would reduce down to 3%. And I suppose that is the key point, and the other key point is that it applies to all taxes. And just the space I was going into before there in relation to IT and CT, IT will not fall within this either, even if you file early, because the due date for IT is the 31st of October. CT is going to depend on when your due date was, and that can be at different dates during the year. So you could have a CT filer who's due on the 23rd of September, cutting it a tiny bit fine, but that can qualify for the reduced rate of interest on the PPA. So good one to point out in that respect. Our phased payment arrangement, which is a relatively new development in terms of the online system that's out there, or for the last, it's last March, 12 months. It's I suppose, a year and a half old at this stage. That's how you apply. It's an online facility. It's a very quick turnaround. I'm stealing I'm borrowing perhaps a phrase from some ad about when it's gone, it's gone. But in our case, when it's gone, it's 10% possibly, maybe 8%. So it's really important to realise that there is a cut-off date. We have no discretion on that unless the legislation change, which I doubt very much at this stage. So maybe we could move on to the next slide, please. So, as I was saying, it's available on the ROS services page. So I have a slide of that, or I'll give you a shot at that in a moment. Again, the critical element in getting any phased payment arrangement is that your returns are filed. You cannot get past go if you don't have the returns in. The system won't let you on. It's a very clean, straightforward online application, almost like applying for a bank loan online. It's a very clean system, but there are some must-haves, and must-haves are the returns have to be filed. Otherwise, we can't quantify the debt that's on record. So it's available debt. All available debt will be presented to you for a phased payment arrangement if you apply for one online. Obviously, all debt that's due will be presented to you. When you apply for it online, there's a fair amount of flexibility within the system in terms of specifying the down payment and the number of repayments. Traditionally, or in pre-COVID, we would tend to be our standard approach would be we would have expected a 25% down payment, and generally we were reluctant to have repayment periods of more than 24 months or 2 years. And again, when I say we would look for those, a lot would depend on the circumstances. In some cases we may say, look, depending on how old the debt was and the circumstances, we might have said, look, it should be paid back a lot quicker, or we might look for a higher down payment, and a higher down payment applied in the case of looking for a tax clearance. A fair degree of flexibility is coming in the current environment. We recognise the difficulties business are under. I mean, this is intended to give them an opportunity to address non-warehouse debt. We have the reduced payment rate. So the down payments, we are quite flexible on those. We're not anywhere near insisting on those, unless the circumstances might dictate it. And again, in terms of the 24 months, the system is designed such that people can apply up to 60 months online. Again, we'd look at a case and say, does that make sense? And if it does, it does. So again, there's a fair degree of flexibility in there. As I say, as you're going through the process, you're actually presented with a schedule of payments, and you can alter it and go back a step essentially and say, you might say, look, I'm going to try and get this out of the way in 36 months. I'm going to pay X amount in terms of a down payment and see where it goes. And you look at it and you see the repayment schedule and you say, maybe not, maybe I'll go a bit longer, or maybe I'll say I'll go a bit shorter, it depends. So that is, you don't commit until you commit at the end and you sign and submit. So you can actually kind of play around is the wrong word, but I mean, essentially you can see what the options are there. Previously as well, we had a variety of supporting documentation that we required in order to proceed with the phased payment arrangement. We have relaxed those provisions as well considerably, and really we'll be looking for the supporting documentation if we require it. I suppose we're with the longer repayment schedule, reduced rate of interest, and reduced down payment, there's a lot more flexibility from the point of view of the customer in being able to spread it out over a long period, and the ability to pay possibly should be better, notwithstanding the current circumstances we're in. So that's where we are in terms of the process. So as I say, the actual mechanism or the actual application process, the conditions and the requirements have eased considerably in relation to this phased payment. And again, then when you get through the process up as far as there's the sign and submit part of it, like effectively you're teeing the whole lot up. It's passed, and you do most of it, completed online. Ultimately, it comes to a caseworker on the revenue side, and they will have a look at it and see if they're happy with it. And if that gets the go ahead, well, then you get a return message, and it's on its merry way. And you have a fair degree of flexibility then within that even as well. When it was built originally, and we have tweaked it, it was designed to allow people self-serve in certain circumstances. So, for example, you have a repayment. You can pick your own repayment date. You might find after a period of time, that's the wrong repayment date for me in my current circumstances. I want to move from the 1st of the month to the 20th of the month. You can self-serve that. I have a particularly tricky month. Something has gone wrong this month. I can't make my payments. I want to get a deferral of a month. You can get that, and you can apply. Where there's a limit on those, but you can make a number of them. So the idea is we're trying to understand the difficulties a business may be in on a given month, and you can so look for a deferral. We do realise that sometimes people hit real roadblocks, and for whatever reason, they're not in a position to do anything for a period of time. It could be illness, it could be anything. We do provide for a longer payment deferral, calling it a payment break. So effectively, we will allow a payment break of up to 12 months on application. That is not completely it's self-service in terms of applying for it, but it's not automatic approval. The deferral and the changing of your repayment date within the month, they are completely self-service, and they're at your own discretion. You don't need any approval on the revenue side. But if you're going for a longer payment break, you do need it does need to be approved on the revenue side. So if we might move on and just have a look at the ROS screen, please. Next slide. So you can see there at my screen now isn't terrific, but it's at assuming you can see the full screen there at the bottom. It does say See, I can't see it on my screen. I hope everybody else can, but it does say phase payment application, the area highlighted in red there at the bottom. And that is your raw screen. You would go into My Services raw screen. When you essentially press on that, it'll bring you in to make the phase payment. It'll tell you have to have all your returns filed. It has to be for a phase payment in excess of €500. And then it will tell you the steps you have to go through, and then essentially you move from screen to screen as you complete it and work your way through to the sign and submit. So that's just the look and feel of it. It's very accessible on the ROS website when you get to it. So this next screen is really an indication of where the savings are. Again, I must make the point that this is the savings in the interest over the lifetime of the arrangement. So what we have here is a couple of scenarios for VAT or Prem, and you will see it's phase pay. If you happen to go online sometime between now and 10 o'clock tonight in relation to your November, December VAT, very nice there as regards a down payment. And if you look, depending on which rate you look at, like let's say even if we look at €30,000, okay, if you go over over 36 months, you can see the savings are 3,000, 4,000 and 5,000 in terms of the projected interest. As I say, there is an element of accrued interest that is not shown there, but what I'm trying to display here is the savings that you make compared to a PPA after the 30th of September. So that really is the significant point. Like, this is sort of the when it's gone, it's gone. So, and you can see the savings are actually bigger in the 48 month, the 4,000 and 60 month, 5,000. And as you go up in terms of value for the phase payment, up to it, obviously the savings increase. So that's an example for VAT and Prem. And if we maybe had a look at the next slide, please. So this is just, again, possible savings for IT or CT. So again, starting today and looking at IT for 2018, that would have been due last year. So just, again, making the point that this year's, the IT that's due this year, 2019, it's not available to it. So the only IT return that it would be available to is last year's or a previous year. And then again, you can see the down payments and the savings based on the value of the PPA and the term of the PPA, the saving in terms of the repayment cycle. So again, they are indicative. If you work it out to the last cent, it may not come out exactly the same, but they're indicative of the savings you will get from this. So we could maybe move on to the last slide, please. Okay. This is a really important point in relation to the phase payment arrangement. If you, for example, and it's the next two bullet points, if you're wish to qualify for the EWSS scheme or the stay and spend scheme, or if you need tax clearance for any other reason, so for example, a license, you cannot get tax clearance if you have debt outstanding. So one way of dealing with that is to put it into a phase payment arrangement. So this is a great opportunity to actually deal with this, and particularly useful to anybody trying to qualify for EWSS. So you set up a phase payment arrangement. You are effectively, you qualify for tax clearance at that point in time, and you can avail of those schemes. In terms of the other items there, I think it's just re-emphasizing the flexibility in application in terms of down payment and the repayment terms, and all the flexibility I've gone through that's in there. And again, there's a detailed booklet available on with that link as well, which covers the warehousing and the reduced interest. Just to say that we have written to businesses that have, most businesses that have debts in excess of generally in the region of 500 plus in the last week. So people should have heard in the last week, got a letter indicating that they can apply for this phase payment. So we've tried to get that to most customers. We have also started a phone contact approach of customers. So just we're conscious, like it's not a sale on revenue's part at all, but this is something that is part of the stimulus package that's there. It's kind of very short time frame. It came in on the 1st of August. It's gone on the 30th of September. And I suppose we're just really keen that people avail of it. It's important from the EWSS, but it's also a great opportunity insofar as there's opportunities around tax. It's, to deal with debt that you might have on record. And as I say, the flexibilities and the terms, etc., around it have eased considerably. And I think that's hopefully a summary of where we are in phased payment arrangement, and happy to take any questions.
Many thanks, Pat. That was a very detailed and practical insight into the operation and I suppose administration of this temporary measures. You said the 2-month measure and the reduced rate of interest. We do have several questions, Pat, now after coming in on the reduced rate of interest, and then I suppose we may, if we have time, jump back into the debt warehousing, because I saw a few others came through the chat function. But just I suppose to go down through the queries now on the reduced rate of interest. One here in relation to, you showed us the raw screen, which is very helpful, where we can identify to go in to find the PPA. But just to highlight here, I suppose, does the old PPA 1 form have to be used, because there doesn't seem to be a link, someone's mentioned here on the revenue website, to a newer type form?
No, I mean, again, we're only we look for the form when we need it. So whereas in the previous, up until quite recently, you couldn't process your PPA unless you completed you couldn't process your application unless you uploaded the form. So you had to upload the supporting documentation. Now, by and large, you can use the existing PPA to give a little bit of an overview. That's all we need. And if we need more, we'll go back. So it's really a very soft approach this time around. So none of the other supporting documentation. Really, you can apply without the PPA. Probably wouldn't be any harm to have it in to give a bit of support, to be honest, depending on the circumstances. But you can certainly apply. And none of the supporting documents are mandatory now at this point in time. A lot of this may change again over time, but in the context of this PPA, none of those items are mandatory.
Okay. Thanks very much, Pat, for clarifying that. In relation to the phase period, I suppose the period that's maximum period, you mentioned 60 months, so someone just raised a question on that. So that's just to, I suppose, say that again. I heard you saying that 60 months is is that the maximum then period for which you can enter a PPA?
No, look, the maximum somebody can apply for online automatically. If somebody wants a longer PPA, yeah, and if they've got a reasonable explanation, again, we look at that. So we are conscious people are trying to recover. It is a favourable rate in these circumstances. So we would look beyond the 60 months, yes.
Okay.
It's a bit like it was before. The standard was 24 months to 36 months. It went up to 36 months. But people did get longer than 36 months, depending on the circumstances. And we're in a new world at the moment. So again, it would very much depend on the circumstances.
Okay, thank you very much. Can betting duty be included in the phase payment for the reduced interest rate of 3%?
Can betting? Well, all qualify. Now, betting duty isn't available on the ROS system, all right, so we'd have to find another way around that. But I mean, what the legislation says, it says all taxes qualify. I suppose I should have said that, like, I mean, the phase payment, the online phase payment system works around 6 main taxes of VAT, PREM, CT, IT, CGT, and RCT. I mean, there are plenty of other taxes there, but and when somebody is entering a phase payment for arrangement for those, there are different mechanisms in place, and probably less. There isn't an online solution as such, but whatever mechanisms apply to handling those phase payment arrangements, the reduced rate of interest applies to them.
And would one of those mechanisms be contact the tax district or contact the Collector General's
exactly.
office directly? So say, for example, the betting duty question there maybe will be to go that route.
Make direct contact immediately. Yeah.
Straight away. Yeah. Given that I suppose we're getting close to the 30th now at this stage.
Yeah.
I suppose we have another question around the PPA 1 application and be updated, and you've already, I suppose, addressed that the PPA 1, the current for outside of this special measure form is not strictly required. So I suppose you've addressed that query already. A few questions around the tax clearance point. suppose try to bundle them together if I can. So the first one is, would both warehousing and reduce interest payment, reduce rate of interest under the PPA, would that affect the company's tax clearance? I suppose you've addressed that, but I'll let you answer that one again.
Well, no, what it does is it gives them an opportunity to get tax clearance if they have debts that would prevent them getting tax clearance. Bottom line again, get the return in, because no return, you can't even apply for tax clearance.
Yeah, but I suppose on that one, because I know it is a common query that will come to us from clients. You know, if you are into debt warehousing or have availed of a PPA and the reduced rate of interest, it doesn't impact your. I suppose tax clearances are kind of set in stone now since the COVID.
Sorry, maybe I missed you there. In terms of warehousing, no, any debt that is warehoused, the fact that it's warehoused has no implications in terms of tax clearance. Any other debt, the only way, you either pay it or you're in an arrangement to pay it. So a phased payment is deemed to be, you're in the process of paying it. So essentially, just to be clear, in warehousing, warehousing is, as it suggests, it's locked away in the warehouse. You do not have to worry about it until the end of period 2. In many respects, you could, if you want to, you could just close your eyes and forget that it's actually there. But coming up to the end of period 2, you'd want to be thinking, what's plan B? And now you're going to go into a phased payment arrangement. So it's all bets are off in terms of.
And I suppose the thing is to protect tax clearance certs, and as you've already mentioned, Pat, for anyone looking at EWSS, that's obviously a prerequisite to going into that scheme. You know, if you have debt you're concerned, or there's debts that you think you'll be unable to pay and it may impact on tax clearance certs, engage with the local revenue district you deal with. Obviously the payment arrangements as they're here at the moment are very favourable, but that has always been the case, that if you're in a phased payment arrangement, it doesn't impact on your ability to get a tax clearance cert, because a lot of businesses will require it in order to get payments, for example, if they're doing a lot of work for the state or semi-state bodies. So just as you said, Pat, file returns, and if you have an inability to pay the debt, engage with the revenue.
Absolutely. And I suppose there's one unusual nuance on this as well, in the sense that if you have debt that is at enforcement in terms of with a solicitor or sheriff, that will prevent tax clearance.
Yeah.
But what you can do is there are certain restrictions on it, and it's covered in the legislation. It depends on what stage it's at, but certainly a lot of sheriff debt and a certain amount of debt that's with solicitor, you can pull it back and put it into a phased payment arrangement, and then qualify for tax clearance. You have to bear in mind there might, depending on the circumstance, that could result in additional accrued interest going on. But I mean, it's a judgment call for the business. If they need tax clearance and the debt is already at enforcement, that's something that they can consider. Again, and I suppose the time to do it now, if you do need tax clearance at some point in the future, and if you say I'm going to do it at that point, difficulty is you won't get the 3% rate.
Yeah. Just moving on then, Pat, and Emer, to another question here. It's concerns, I suppose, a liability that arose in the context of a revenue audit and is now going to be settled by entering into a PPA at the 3% rate. Does a down payment, and they've given an example here, say 40%, still apply if tax clearance has to be obtained, or do they require any down payment at all? So maybe Pat, would that be for you? It
would, yeah. Now I suppose don't know what the discussion on the audit is, but traditionally or up until now, we would have kind of insisted on 40% down payment in relation to tax clearance. We wouldn't be insisting in the current environment. In this situation, we wouldn't be insisting on 40% as being the rule.
Okay.
Again, depends on the circumstances of the case, what the auditor feels in terms of what is the appropriate down payment. But in terms of the kind of standard rule that was there and that would be in the guidelines that have issued of 40% in order to get a down payment in a PPA for tax clearance, no, that has been relaxed as well.
Okay. Thanks very much, Pat. Just in relation to, I suppose this is one about a return now, so don't shoot me, but I suppose the return can't be submitted until the start of November, and I'm assuming this is a CT liability. It's not quite clear, but I suppose is there any flexibility for a balancing payment on the 2019 tax liability if the return cannot be submitted until the start of November?
If the due date is not before the 30th of September, you're caught.
Okay.
It's basically, the legislation is unpaid tax. and it can't be unpaid tax until you've gone past the due date. And that's
And
that's
take
it in
it,
a nutshell.
and take, I suppose, take that a step further. And if the due date, if it is, say, CT, for example, and it's a December year end, and the due date is 23rd of September, which is prior to 30th of September, but the return is not filed. Now, you were very clear earlier about returns, is the key message, and has long been, I suppose, from revenue and your office to continue to file your returns and on time. If the return cannot be submitted until the start of November, but it was due, say, for example, the 23rd of September, just say for whatever reason.
But that means you're not applying for the phased payment arrangement until November.
Yeah, so then that would be the...
That would be the difficulty, yeah.
Emer, did you have...
Yeah, and I suppose on that point in terms of CT filings, because I know it has come up on a number of forums at this stage in terms of difficulties in getting accounts finalised for various reasons this year. There may be delays in that, businesses struggling to meet that 23 September filing date. And I think Revenue's messaging, Pat, correct me if I'm wrong, is very much to file the return, and if you need to do a correction once you have final accounts. So if you need to file using your draft accounts, do that. And if you need to do a correction, subsequently you do that. But I suppose from the CT payment perspective then, it means at least the return is filed, and if you did want to warehouse that CT debt, at least the return is in that period. So my understanding is that would fall into it in that case, Pat.
If with the general rule in relation to the debt warehousing, and I have to clarify, but I presume it applies in this, would be that best estimate, or the equivalent of a best estimate if it's in. Now, I suppose there would be a kind of a scenario on it, like if the best estimate is significantly out of kilter with the ultimate
Sure.
return, the gap between it and what was filed. If the idea is to get it into a phased payment arrangement, the excess possibly would not qualify for the 3%. So I mean, that's right. Again, if it was very close, I'm sure it's a different scenario. But if
that's a negotiation point. But no, I take your point. I think that's reasonable, to be fair, that if we are filing based on draft accounts, that you try and ensure that they're as close as you expect the final liability to be using best estimates. And management accounts should position us in a place that, there might be audit adjustments or accounts adjustments to be made, but broadly speaking, for businesses that have been trading in prior years, to get as close to that estimate as you can for the 23 September filing.
Yep.
Thanks very much. I suppose I'm just conscious of time as well. So if it's okay, we'll take another couple questions, Pat and Emer. I'll bundle them together. I suppose back to the preliminary tax point. And I suppose just using if we use preliminary income taxes as an example, but specifically now, Pat, in relation to preliminary income tax for 2019. So that would have been, I suppose, due.
So we're talking income tax now.
Yeah, preliminary income tax is what it, so I'm talking about the reduced rate of interest. So if we take income tax as an example for 2019, would have been due last October. The questions coming in here then is, could that be subject to the PPA at the 3% interest rate?
It could, but just bear in mind, if the interest rate if the preliminary tax rules fail, the due date bounces back to 31st of October last year. So that would be the due date for that return. So it could fall in. You will have accrued interest between 31st of October 2019 and whenever the phased payment arrangement is agreed, and then you have 3% on the balance. But you will have that anyway. So certainly that is one situation where the 2019 return could qualify for the phased payment arrangement, and it would make good sense to try and get it in there, possibly if you're going to be looking for a phased payment arrangement. I suppose one other point to make, like the 3% interest rate is only a value if you're looking for a phased payment arrangement. If you're in a position you can pay all the tax off even if it's late, it is of no value to you because the accrued interest up to the date of payment is still sits in there, and that's and that is kind of the fundamental point. And I just want to, that it's very easy to lose that when people hear about the 3%. If you have debt, you just have to realize that it is from a current date that you're getting the reduction in interest, and it's over the lifetime of the arrangement. I suppose the longer phased payment arrangements and the reduced down payment, do make it very attractive on that perspective. But the accrued interest it's accrued. it isn't a retrospective introduction of a reduced rate of interest. It's a prospective one, really. It's from today onwards.
Thanks very much, Pat and Emer. Just back to, I suppose, an audit scenario on if a qualifying disclosure has already been made, can any balance that's outstanding under the terms of that qualifying disclosure, I suppose, and a PPA is entered into, can that benefit from the 3% interest rate?
It can, I suppose. Best approach, I mean, it depends on, there could be a variety of different kind of stages somebody is in. But clearly, if the relevant area and revenue, they've been contacted, the liability is being quantified, there's a clear repayment proposal. If that includes a PPA, that's part of it, and the return is in. So I suppose, if you have that sort of a package there, and it sounds like you're in that space with that particular one, but that's it. That there's been kind of a good engagement with the division, spelling out quantifying the liability, agreeing how it, saying this is how we propose to address it, get the return in, and I suppose the only thing is make sure it's all signed off by the 30th. You want to make sure that they have any kind of backup material is maintained in the event it's required. So certainly it can qualify, and that would be something we would be saying, but you need to be able to kind of get it to that space quickly, or really, whereas I understand most of a number of our divisions have been making contact where any case is at a reasonably advanced stage to say, look, this is an opportunity to close it out if we're that close, and and it's not, and to be honest, it's really just we're conscious, it's a deadline that's imposed on us. We don't have any discretion on this, so we're conscious that we don't want anybody kind of come back to us afterwards saying we should have known about it. So hence the webinars, the press release, the letters to everybody as best we can. So we're keen that people benefit if they can.
Great. Pat, just on back to the ROS steps. So has anything changed in terms of the ROS steps for this new reduced rate of interest measure when you're doing the PPA? I know you've already touched on it, it's just specifically been addressed. So are the steps the same? Although PPA 1 isn't strictly required, nothing has changed on the ROS side in terms of the steps that would be required for now versus what we would have done 6 months ago.
No, except yes. Sorry, I'm not sure. Yes or no? The answer is you go through the process very close to what it was before. I mean,
okay.
The key fundamental that hasn't changed is no return in. You don't get in the door. It'll say, look, you have returns outstanding. Once you have a debt of over €500, you're in. It'll present the liabilities that we're aware of that are on the system based on the returns that are that are in, whether they're part or fully paid. And it'll present them to you, package them up, and kind of you can go down your route of, how many periods do you want to pay it back? What's your down payment? It's exactly the same as before. The main step further on down the line of a change. Some of the text has obviously changed because some of the requirements have changed a little bit, in terms of looking for, I think, references to interest rates. I can't remember. There's a few things that have changed. Stuff around the deferral. I think it mentions a 6-month deferral. It now says the 12-month deferral. So all of those, those are more easings of existing functionality and requirements as opposed to changes what you need to do for a phased payment arrangement. So you go through exactly the same steps, but you don't have to reduction in terms of the documentation you need to provide. That is the main thing, and the rest of it really is kind of easing in terms of extending the payment break, reducing the down payment. And obviously the 3% kicking in, and obviously the 60 months kind of being available on the system.
Great, thanks very much, Pat. Just I suppose for the interest, if you don't mind for one more minute, the interest of those who did pose some questions through the chat function, I suppose I just was focusing for the while there on the Q&A option, but I suppose that most of the comments coming through the chat function concern around on the debt warehousing now. So we're going back to the debt warehousing. So
that's fine.
Okay, that's okay. And really it's again around this whole period 1, and the general theme of the chats are, we continue to trade throughout period 1, had no turnover loss but significant cash flow issues from debtors, etc. Can warehousing still apply to the VAT and Prem in those scenarios?
Well, if they're a business or personal division case, let's take that as being a standard category. Yeah, they can qualify for warehousing, notwithstanding they continue to trade. The fact that they continue to trade, our approach is we'll say, look, you're in phase 1 in terms of the government roadmap, which means you resumed in the May-June period. So your end of period 1 is the 31st of August. So you can warehouse debts, VAT and Prem, up to the 31st of August for your period 1. Thereafter, we'd be expecting people to be file and pay.
Thanks very much, Pat. Emer, I'm not sure if you have anything else you want to add, or generally on the kind of theme of the questions.
No, I think, I suppose, I know we've said it tirelessly throughout, but I mean, filing of the returns, absolutely imperative, and engaging with revenue. If you're not, kind of a round peg that'll fit neatly into what's outlined here, engage with your local revenue district. As I said earlier on, certainly our experience in dealing with revenue on behalf of clients who are falling into the non-SME sector is that they are taking a very pragmatic and fair approach with taxpayers, which is very encouraging. And as you said, Pat, the idea here is to give businesses an opportunity to get back on their feet and try and preserve businesses and preserve employment at all costs. So yeah, I suppose that they will be the key takeaways, I think, from today, just to continue to file. And even if you're using estimates, file using those estimates, but just to have the filing in. Obviously the correct figures do need to be filed, but just to be sure that that you meet those filing dates.
Great. Okay, well, thank you very much, Emer, and thanks very much, Pat. I think we can conclude now. We've, I suppose, run over on your time, so but I suppose just thank you both and very much, and we'll close it now if that's okay.
That's great. Thanks very much.
Thanks very much, Pat. Take care.
See you.